Hi everyone, this is Jason Collins with URL Insurance Group. I'm here to quickly talk about the differences between life insurance linked benefits versus your traditional long-term care. A lot of times I see some, misnomers or some questions as far as where to put my clients, or quite honestly, clients don't even know which avenue that they want to go towards. So it's really good to know the differences and the pros and the cons and how these certain products can help your clients. That way, when the conversations arise, you know exactly, that little bell in your head goes off when you hear, I don't have any life insurance, but I do have some concerns about long-term care. That you are aware of what's out there in the industry today. So let's get started. So, what is traditional long term care insurance? Traditional long term care insurance is exactly what you've known, what your parents have known, what your grandparents have known. It's coverage that it's going to provide in nursing home, in home health care, personal and adult daycare for individuals age 65 or older. It offers more flexibility and options in many public assistance programs such as Medicaid. So, if somebody does have some, real long-term care concerns, Medicaid isn't going to be there for them like a insurance policy would. So, what are the life insurance linked benefits? So it works essentially the same. A lot of same designs. They're built on a long-term care chassis, the life insurance is, but there's a little bit of added oomph to it. So, you're able to provide a death benefit should you get hit by a bus. There's a pool of money to be covered for your long-term care needs. So it kind of covers both aspects of it. It provides you with the long-term care pool of money, but it also is something that will provide a death benefit should your client's early demise, whereas the traditional long-term care doesn't. And we'll touch on that in a little bit. So some of the pros of the traditional long-term care coverage. We'll get into the pros and the cons of each. I like to be able to show you exactly, the good and the bad of these things. So the traditional long-term care, it certainly provides coverage for the home health care, the nursing care, the assisted living. It offers flexibility in how you want to choose your benefits depending on the policy, and allowing you to obviously care options that suit your needs. Lower initial premiums. Now, I will see this. I do see this a lot. I will and I do. A lot of times people get enamored with the fact of they have, the traditional long-term care it doesn't have set pricing. It's very low compared to, anything else that's out there in the market. And people get pretty excited about that. But we'll move on to the cons with that. Yeah. So initially they have low pricing. They have the pros, the customized options. So you can choose to, the death benefit period. I'm sorry, not the death benefit, but the long-term care benefit periods, the daily limits, the inflation protection, to match your personal situation. So that's really good too. It is able to customize it a little bit more. You're able to offer anywhere from 2 to 4 years worth of monthly benefit for your clients. Now they are all reimbursement style with traditional, so your client would have to submit receipts and have a situations like that. So that is something to be aware of. But they do offer customized options with long-term care. Now the disadvantages of long-term care. So again, we talked about that. There's a use it or lose it aspect of traditional long-term care, meaning that clients can be paying into these long-term care policies for years and years and years and years and years, come up with some cancer, get in a car accident, they pass away, they get nothing in return. The family gets nothing in return. It was never utilized for the long-term care needs because up until that point they were perfectly healthy. They didn't need any sort of care. So you roll the dice of possibly wasting money, wasting the premiums that have been paid into. Here's the thing that we were talking about before with the disadvantages. Even with the low premium prices that we talked about in earlier slides, the premiums on traditional long-term care are not guaranteed. So over time, the company has its ability to raise the prices on your clients. They'll get a notification. They will get options. A lot of times they will get options. Now they'll have to perhaps get rid of the inflation protection that they've had paid into for all those years, or maybe extending the elimination period. So there's ways around that you can diminish and lower those premium payments. When the time comes with a company, but the fact that your clients are going to have to worry about that is something that they need to know. You and they need to know about that. So the premiums are not guaranteed, and they have strict qualification requirements. When I say strict qualification requirements, it's 2 of 6 activities of daily living is a lot of times with the trigger with all of these. So you're being able to the things you and I take for granted each and every day, the going to the bathroom, the getting a shower, the moving, the eating, that sort of thing. So that's the qualifying case for the traditional long-term care. So let's get into the pros of the linked benefits. Again, if you don't need the long-term care, if the cancer hits the client, if the car accident hits the client, and they never use the policy, there is going to be a death benefit that they are able to pass on to their loved ones. And a lot of times I get into the conversation where people will say, Jason, my clients have enough life insurance. They don't need long-term care and life insurance. And I try to get them to kind of reposition their thought process on that, because to me, the life insurance is just a return on your investment. It's a return of premium. A lot of times the premium paid into is going to equal that death benefit. So, again, we talked about that these life insurance policies are based on a long-term care chassis. So the long-term care is really why you're purchasing this. It does have that cherry on top with the life insurance. So it is more like a return of premium. But again, they're getting something for their money. So it's a better return on investment than your traditional long-term care. No premium increases. Unlike the traditional long-term care, the linked benefits are going to be all guaranteed. The premiums will never increase. Doesn't matter if you choose a single pay option, you choose a 5-year payment plan, a 10-year payment plan. Some have a pay to 65 plan depending on the age of your client. Some have a pay to 100. So we can really cater this to try to get it. If somebody is comparing apples to apples, and we'll show this in some later slides, but if they're looking at apples to apples comparison between the linked benefits and the long-term care, traditional long-term care, what I try to like to do is run that out to as far as I can, because the premiums for traditional long-term care are continuous. They'll never end. That's another con to traditional, in my opinion. With the linked benefits, you do have an end in sight if you want that. They do pay to 100. So I will, if I'm doing an apples to apples, I'll show the pay to 100 and I'll show against the traditional long-term care. Return of premium options. So this is kind of cool too. This is unique to the life insurance linked benefits as well. Is that there's options for cash on return if that's a concern for your clients. There is cash value. So unlike the traditional long-term care, there is cash value that your clients can take out, borrow against. And again, we can all customize that to more of the driving force. What's more of the conversation? What's more of the concern for your clients? Is it the long-term care? Is it the life insurance? Is it cash value? So that's a conversation that we can have, and we can determine what is best for your client. And more straightforward qualifications. A lot of times with these linked benefits, they underwrite these different. So whereas the linked benefits are looking like life insurance, they're going to be looking at your health, the cancer history, that sort of thing, underneath the hood, I would say. Traditional long-term care, they look at, canes, something like that. So somebody who can't get traditional long-term care might be able to get life insurance, and vice versa. They all have cognitive screens, so that's something that you need to be aware of for your clients. But the underwriting is different for each. So again, if they have health concerns, we can always pivot into another category. All right, so the disadvantages of linked benefits. So, I put this in here because I hear this a lot, the higher initial premiums. Again, I'm going to show you in some later slides, it doesn't have to be like that. You start getting into the higher premiums when you shorten the premium period, being the single pay, the 10-year pay, the 5-year pay, that sort of thing. Because, yeah, the traditional long-term care is taking it out to the life of the client. So they're able to minimize those monthly premium payments. So again, it's all about the conversation. Do they want to pay a little for a long time, or do they want to pay a little bit more for a shorter period of time? We let that up to them. The complexity, there's a lot of moving parts here with life insurance and long-term care. Be talked about with the long-term care aspect of things. You have the cash value numbers that they're going to be looking at. You have the death benefit they're going to be looking at. You have like their monthly benefit. So there's a lot of numbers that could be confusing to clients. That's why we're here. I'm more than happy to sit down, run over the illustrations with you, make sure you are fully understanding exactly what you're looking at. And that way, when the questions arise, you're able to sit down and have those conversations with the client as far as the kind of the inner workings of the policies compared to the traditional. So I don't know if you can see this. This is just a little summary of what we talked about and the differences of each. We'll kind of go in there. The primary purpose is there. The traditional is the long-term care coverage. We talked about the linked being with the combined aspect of things with the life insurance and long-term care. The premium structure. We talked about the continuous versus, the higher premiums but a shorter period of time. Use it or lose it. Again, traditional long-term care. You pay into it for 20 years and you meet your demise. There's nothing there for you. Unlike the linked benefits where there would be a death benefit, for your loved ones. Again, the legacy benefit, death benefit versus non-death benefit. So again, you can read that. That's not. I'm going to go down slide by slide here with that, but yeah. So I think it's one of those things where it's good to know the differences of each and where each fit. So let's get into some examples. All right. So I talked about. So what I wanted to do is I wanted to show you everybody here the differences. So what I ran it out. This is a pay to 100. This is a continuous life insurance. This is on a female age 55. She's provided a 4-year benefit. You can see there the day one monthly premiums $303 a month. Again, that's not guaranteed. That's guaranteed today. That may not be guaranteed for what she's going to be paying tomorrow. I see it all too often to where clients come into the office here and say, they're increasing my premiums. I can't afford these anymore. What do I do? And now they're forced to kind of make a decision as far as, like I said earlier in the presentation, they have to extend their elimination period, get rid of inflation protection. So now they're making changes to something that they've been paying into at a later point in life, when they're closer to using it than they're not. So, that's a tough conversation to have. It's unfortunate. But going back to this, so day one, $303 a month. The day one benefit is going to be $3,000 a month. Now we did add inflation protection, so 3% compounding. So at the age of 80, that $3,000 has grown to $6,095 a month. So again, all reimbursement. Submit receipts. They would have a concierge service for you to help out. But yeah, so there's no cash value, no death benefit. It's just, your 4-year benefit is going for $300 a month is going to give you this amount. Now let's go back. Let's go see what the linked benefits do. So same example here, linked benefit, female age 55, 4-year benefit. Now you can see down here, the premium to age 100 is $307 a month. So that was $303 for the traditional. So not that much different, but look what you get. Still $3,000 a month. Starting day one long-term care benefit, added the 3% compounding, just like I did with the traditional. Now that benefit has grown to $6,281 compared to that $6,000 that we looked with the traditional long-term care. Oh, and so for $4 more, Mr. and Mrs. Client, I'm able to provide you more growth. I'm able to provide you a death benefit of $95,806, which essentially at age 80, which is essentially the amount of money that they've paid into to this policy. So that's where that return of premium comes from. And it has the cash value that you're able to take out against if you ever want to do that. So again, for $4 more a month, they're getting a tax-free death benefit should they need it. They're getting, and a little bit more long-term care needs. So to me, that's a no-brainer when you really try to do the comparison, apples to apples. Again, that's why I like to run this out to age 100, because that really does give you the better sense of, what the policies can do to compare against the traditional long-term care, policies versus the 5-year pay, the 10-year pay, because of course it's going to be more expensive because you're shortening that premium payment period. So, and that makes sense. So who are the clients for traditional long-term care? People that want the highest long-term care premium per dollar. Again, some people are just like, you know what, I want to roll the dice. That's cheaper for me right now. I like that idea. That's fine. There you go. You got traditional long-term care. They don't have heirs. They just are looking to cover themselves. They don't really want to mess around with any of that kind of stuff. Can't afford the hybrids. Again, going back to that, would like to qualify for the partnership program. Now, that is one thing to know, that the partnership program, at least in the state of Pennsylvania, is only available to traditional long-term care. So it is not available to the hybrids. So if you have any questions about the partnership program, reach out to me, and we can certainly talk about that. And don't want to tie up the assets at current interest rates. I put that in there as far as, a lot of times, we talked about the single premium life or the hybrids being a single premium. So sometimes people don't want to tie in $100,000, $200,000, $300,000 worth of premiums. They want to keep it, they want to control it, and they want to just be able to pay out, to the traditional long-term care as they see fit. Now, who are the clients for the linked long-term care? Somebody who is concerned with the use it or lose it. Somebody who does have family members that they're looking to pass on the money to. And again, somebody who likes to have that idea of the return on investment. I want to be able to have the money get back to me. I want to be able to know that I can either use it or not. So, if I can't use it for my long-term care needs, at least I'm able to give it to a loved one, friend, church, pet, whoever they want to give it to. So that's a benefit. The guarantees, again, I'm a fan of guarantees. I like the guarantees. The hybrids, the linked benefits, they're the only ones that are able to provide that for your clients. So if that's a concern for your clients, again, at age 80, at age 85, who wants to be messing around with a bunch of receipts and things like that? So to me, just give me my guarantee. They have lazy assets. So, I like this. A lot of times, the older generation, when I say older, like my parents' generation, which have passed down to me this thought process. CDs were really big. Savings bonds, CDs, they were really big back in the day, and 30 years ago or so, 40 years ago. And, we're starting to see a little pivot there where, you say, Mr. and Mrs. Client, what are these CDs for? Oh, I'm just there to leave to my loved ones, my grandkids, I don't really need that money. Well, they're paying taxes on that each and every year on all that gain. Why not move those CDs into something like this to where you're able to, protect yourself for any sort of long-term care concerns, any home health care concerns. Oh, and by the way, if you don't need it, then you are still able to pass it on to your beneficiaries, your grandkids, whoever, tax-free. So that's a selling point. 1035 money. I see this all the time. People have old life insurance policies that they don't need. The kids have grown. It's now the mortgages are paid off. They just don't need that $1 million policy anymore. But there's cash value built up in there. You are absolutely able to take that cash value, roll that over into one of these policies. The client's never going to have to pay another dime if they don't want to. And now you have a paid up long-term care policy with life insurance attached to it that your client will be able to add inflation protection to. And now you're making that money grow for them as far as any sort of concerns. Simplified issue, again, with this, they are telephone interviews. So the client will sit on the phone, have some health questions. They'll want to do a camera view with you, make sure that you're your head's okay, Alzheimer's, dementia, everything like that. But it's all simplified issue. They're not going to have to worry about getting poked or prodded or giving blood or urine or anything like that. It's just a phone conversation. So super easy to process to go through. So that's pretty much what I got. I just wanted to go over and just touch on the differences between the traditional long-term care and the hybrids. Again, as the baby boomers are starting to get into that age 65 and up period of their lives, it does make sense to start having these conversations, just to have the, oh, by the way, at the end of your annuity conversation, at the end of your Medicare conversation. It's just that, we're doing ourselves and our clients a disservice, quite honestly, by not asking the questions, because if you aren't, somebody else is. So it's just, it literally takes 30 seconds and fire up that conversation, stoke those flames, get it in their brain. If there's questions that you have, always feel free, give me a call. My number's right there, 717-216-8038. I've met with clients before, so if you're not super comfortable with this, allow me to assist you so that you can be. So again, everybody have a great weekend. I appreciate your time. It's Friday. I don't know who everybody's rooting for in the Super Bowl. We're here in Harrisburg, Pennsylvania, so we have my friends are a lot of Philly fans, so I'm rooting for my friends. Love my friends, so go Birds. All right, guys, have a good weekend.